Good morning, everyone, and thank you so much for coming. Here we are, day 3. Everyone has been working, learning, thinking, talking, and I hope you can enjoy the next hour where you can appreciate, because we are among some of the most interesting people in the financial markets right now. My name is Stephanie Ruhle. I'm a morning anchor with Bloomberg Television. Our topic this morning, reading the tea leaves in these ever-changing global markets. And I want to kick off, I actually want to allow our panel to introduce themselves. Justin, I'd like to start with you, just to give us an idea who you are, where you're from, and what your firm invests in. And from there, we're going to dig into the markets. Justin?
Sure. Justin Slatke at Shankman Capital. We are a global leverage finance player. Our main focus is bank debt, high-yield bonds, and convertibles. And we play across the entire leverage finance part of the capital structure.
I'm Morris Mark Asset Management. We're primarily equity investors. We run hedge funds and asset management accounts oriented towards equity investment.
I'm Jim Latinsky. My firm is JHL Capital Group, and we are an opportunistic long-short equity credit investment firm. We're pretty flexible and opportunistic.
I'm John Kalmos from Kalmos Investments. We have a wide range of products from convertibles to global equities, growth equities, high yield, and some alternatives as well.
Michael Sembelos, the chairman of Market Investment Strategy at JP Morgan Asset Management. We're responsible for around $1.5 trillion of endowment, ERISA, and high net worth assets.
John, I'd like to start with you. You put your shingle on your door in the mid-1970s, focused in the convert market. Okay. Compare when you began your firm to today, what the opportunity set looks like, how different it is.
Well, I guess the one thing I've learned, you know, from the 70s to now is nothing changes very much. There's risk, and you have to manage risk. And in the 70s, it was a very volatile market, but it was inflation generated, where this market is there's no inflation, there's very low interest rates. The market back then was high interest rates, high inflation, but still had a lot of volatility. But there are some, I think, similarities to the current market, a lot of uncertainty going forward in here. How do you manage risk? How do you manage bond risk in this market? So those things haven't changed.
Michael, as you look across all asset classes, because in your position, you look at everything, what are you most focused on right now?
Well, waiting to see the growth and profit numbers pick up. Last year, for the last 30 years, I don't remember a year quite like last year, maybe 1986, in terms of a year when the financial markets did really well and the profit and economic growth numbers weren't so hot. And so this year, our view was that equity markets were going to move sideways until the growth and profit numbers improved. The Q1 growth number in the U.S. was pretty terrible, but the leading indicators look a little better for the rest of the year. And I would say I'm spending about 70 to 80% of my investments time just focused on those two issues.
Jim, if the equity markets are going to move sideways, what are you going to do all day?
Yeah, that's a good question. Well, I don't think they're going to move sideways. I actually think that, you know, if you think about what's happened in the last couple months with this momentum sort of blow up, I think that there's been some shifting of capital into other areas of value in some of these areas. And I actually think, though, that this momentum blow up is a tell. And, you know, when the speculative phase of a market cracks, you know, that's a warning sign for what I think is going to be, you know, when I look around this conference and sort of it feels as if people are sort of pretty muted in their concern, and there's somewhat bullishness, not major bullishness, but we have been in the longest bull market in history, actually. And if you think about a time when conditions were even much better, think of the 80s, you know, 82 to 87, and you still had a crash. And so we've been over 5 years, people are quite complacent. So I think what you're going to see is my expectation is that you're going to see what happened in momentum probably carry over into other asset classes. Small cap stocks, we can talk about that, I think are you know, extremely overvalued. And then I think it's going to carry forward to some of these buyback stories and conglomerate boom stocks. And there's a lot of investors, especially in hedge funds, who are piled into these. And I think just like momentum, when they try to get to the exit, you know, everyone thinks they can sell in time, but they won't be able to.
Is there even enough liquidity or support by the street in small caps right now?
Well, in individual names, it's, it depends. It's sort of, it depends on the individual name. You can certainly, if you look at the ETFs, let me just give you a data point because this is fascinating. But, ordinarily you would expect the forward earnings of the small cap index to, it typically goes like this over time. And so at the bottom of a cyclical recession, the forward earnings multiple spikes because earnings have been lower and you'd expect earnings to recover. Well, we've been in a 5-year bull market, and interestingly, due to QE and all the money coming into the system and the view that the U.S. is the safe place to be and that small caps are sort of the most U.S. focused, you've seen the forward earnings multiple go sort of somewhat asymptotic, especially in the price to sales multiple in small cap stocks. And so just as a data point, people say, oh, well, the Russell's at 19 times forward earnings, and that's not crazy expensive. Well, if you look at the Russell data, so not Bloomberg, with all due respect, if you look at the Russell data, the street is expecting, right? The street is expecting 80% earnings growth in small cap. Now, the data's a little messed because there's a lot of money losers and there's a lot of, but that's always been the case. And so I think you're set up for one of two scenarios, both of which lead to a collapse in small cap stocks, which is either the earnings are so good that they hit these numbers and GDP growth is 5% and the Fed has to hike and there's an inflation scare, or more likely, there's disappointment and the multiple goes further asymptotic and people recognize maybe this is sort of the next, this is the next area where capital's flown and kind of people come out.
How you feeling these days?
I'm feeling pretty good. I think I respect Jim's comments, and I think we have a different perspective. We started our firm in 1985, which was 3 years into what turned out to be, not taking into account the crash of '87, which we did pretty well with. It was a 14-year bull market or a 15-year bull market, depending on how you figure it. I think the way we sort of look at things right now is that strategically equities, particularly equities domiciled in the United States, not necessarily operating here, are really valuable. And if you look at it in a broad context, we're sitting in the middle of Beverly Hills right here, and I had dinner with a friend of mine the other night, and he made a simple point that the real estate market here has turned in the last year, that the inflow of foreign capital has rapidly expanded the values of a lot of commercial real estate, so much so that even though he's a long-term investor, he can't avoid selling at these cap rates. The residential market, when they put a house up, there's somebody, usually from a foreign country, just snaps it right up. A similar phenomenon in the East. And I think what that says to me is two things. That one, this flow of capital that comes here for security is eventually going to come here to also grow. The spread between the yield in that commercial real estate and the high quality names that you and I know is pretty wide. So I think that's a secular trend that we can't disregard. And I think a couple of other things, and I'm not even getting into the economics of this yet. If you go back, let's say 27, 28 years when we started, there were 9,000 public companies. There are 5,000 today. With all of these new issues and the speculation, a lot of which has been knocked out of the market in the last 2 months, and they're probably going to knock it out some more. We don't own Twitter. We don't want to own Twitter, okay? We do own Facebook, so we'll get back to that if you want. I'm not talking book as much as to make a point. Quality is going to do well, and I don't see speculation anyplace outside of the area that's just getting bombed. So that's just one other thing. And one other thing in terms of supply, it's just not 9,000 companies to 5,000. Look at the buybacks. And that's real money. It isn't a small IPO. It's real money. And you can think of the companies right off the top of your head that keep announcing big buybacks. There's one recently that just borrowed $12 billion at about 4% so it can buy its stock back. That's interesting.
But when you talk about the inflow of capital in the real estate market in places like LA, Manhattan Beach, Beverly Hills, and New York City, is that truly a reflection on the U.S. economy? Because between the East and the West Coast, there's a lot of real estate where no foreign investment is coming.
Well, absolutely. I think that there's a lot that should and could and maybe, depending on what decisions are made, will be better about the American economy. And I think you've got to take that into account and look at any company's earnings. And I made the point that I want to be in companies domiciled here, but not necessarily just operating here. You want companies that are structured to take advantage of the growth in places like China and Southeast Asia. But I think people are going to like the idea of knowing that when they buy something here, just like when they buy a piece of real estate, they own it. Their ownership will be protected. It will not be confiscated. They always have the risk of assets someplace else. But if it's an American company, and this is still the biggest, most prosperous, and I would say most powerful country in the world, people think hard before they do something.
Justin, do you want to weigh in? Many people say right now there's no great opportunities in credit. It's crowded, spreads have gotten so tight, lending standards have worsened. What are you doing all day over there?
Yeah, I think that when you think about the credit markets, there's a big difference between trying to get outsized returns and trying to get interest income accumulation over time. And we've clearly moved in the part of the cycle where we need to really focus on interest income accumulation and thinking about approaching the credit markets in a slightly more conservative way. For anybody that's been here at the conference for 2 days or in the bull market of the last 5 years, we all know that financial assets have been inflated across the entire United States. And the question is, what type of environment are we in now, and where can you hide, and where can you continue to get reasonable returns? And if you think about the environment, we have an abnormally low interest rate environment, which is likely to continue for a minimum of the next 12 months. We're in a low inflation environment, tepid GDP at best, with the 0.1% that we saw this morning, and a very low default environment. That's an exceptionally good market for spread-related product, which is what we've seen over the last couple of years. As we look forward, most of those factors over the next year are likely to stay similar. And so as a result, we think that high yield will continue to do relatively well. If you look maybe at page 12, which is a slide that we've put together to talk about where we are in the markets, because there is so much talk about whether it be a bubble or that high yield is totally uninteresting at this point. On page 12, if we get there, what you'll see is we've just crossed inside of 400 basis points for the first time in a while in high yield. The last 2 times that happened was from 1996 to 98 and 05 to 07. Both those period of times, we stayed inside of 400 basis points for 18 and 24 months respectively. And the returns, as you can see, were high single and low double-digit returns. We're not expecting that in this environment, given we're starting at a much lower all-in yield. But I think it's too early to run from the high-yield market when you look at the statistics of how the markets have performed historically. The one area we would say is we are a little worried, to your point, about credit standards. We're a little worried about the lack of credit differentiation in the market. Triple Cs are up 43% over the last 2 years. And we do think that investors are probably not getting as much return as they should for going all the way down into the cap stack at this point, and would suggest that investors look to take a slightly more conservative stance within the market.
So on that point, if I can jump on credit standards, so this is just a fascinating thing that I think people might be interested in, something we're seeing that kind of blew my mind. One of the reactions, because the Fed has pumped the systems with so much liquidity, one of their concerns has been excessive risk in the leveraged loan market, and there's been a lot of retail capital that has flooded into it. And so the Fed and the OCC put out some regulations last year to monitor aggressive lending in banks to make sure that the leveraged loan market didn't get out of control, specifically with financial sponsors. And so what we've seen, and we've seen this in multiple deals, and we've heard this anecdotally from sponsors, is that with the Fed and the OCC in the banks, the bankers, what they're doing, instead of not making the loans, is they're telling the private equity firms to up the projections. So, we see some of these deals, and look for they're gaming the system again, and you see, and it's, you see a deal going from one sponsor to another sponsor, and there's 50 million or 100 million of EBITDA, pick your number, and then all of a sudden the new deal, EBITDA is up 30% on expected customer wins and cost cuts, financial sponsor to sponsor, and so leverage stays the same, to the regulators, but certainly the leverage is not really the same if unless you believe the numbers. So.
Michael, when Justin,
I was just saying, if any investor is investing on the private equity's expectations of their own companies, they're
well, those are the leverage levels,
trouble, no matter what. Yeah. But the regulation is, I think, a big deal. I do think that the Fed is trying to lower leverage in the system artificially because they don't want to raise rates. And that generally does create problems within the financial markets because the financial markets move very quickly and they'll find other ways to finance that potentially lead to more illiquid type securities, which over time I think really does create a real potential risk in the markets. I think anything that creates more liquidity or ways around what we have, which is a fantastic capital market system in the US, it should be something that we all are worried about.
I think you raised a good point, Justin, and that's the fact that you've got a Fed that is still focusing on the quality of bank assets and the size of bank capital. And that's probably one of the things that's going to keep short rates lower and maybe long rates lower than we expect for some time, because Janet Yellen is viewed as an easy money person, and I think ultimately she is. And I think we better not forget some of the other things she wants. But she also is what I think one of the, she wants inflation. And I think you can't forget that. She's in effect saying she's targeting inflation. So if you target inflation, at some point it's going to be reflected in interest rates. I don't expect it this year, but I do plan on that, and we're structuring our investments accordingly. I think you've got to not worry about it, but realize that when, as, and if that happens, you want to be on the right side of that. You want to be with investments that can handle it and or can benefit from it. But I think right now, I think the message is, I think to remember, and that's why I like this Fed. I think this is a really good Fed. She was the first person on the Fed, I think in 2007, to highlight the housing issues and the regulatory issues with regard to housing. So you got a balance there. You got a Fed that says they want inflation, which means they're going to keep this up until they get it. But it also a Fed that wants the economy to grow on a firm foundation. And at some point, the banks will have enough capital. At some point, they're going to really feel good, and loans will expand, mortgage lending will expand, and that will strengthen the economy. And it'll strengthen it without speculation.
John, you want to weigh in?
Yeah, I think one of the things, too, is there's so much focus on monetary policy. Somewhere in here, we have to focus on fiscal policy. What's going on? Because what the economy wants is job growth. Where does job growth come from? It comes from small business. When you have a very flat yield curve, where you have over-regulation, there's no incentives for banks to make loans to small business, you have no job growth. And if you have a very flat yield curve here, there's no incentive for a bank to make a loan. So part of what has to happen here is really to see, actually a rising interest rate environment would be positive for the economy, not a negative. We went to a more normal interest rate environment. So, you know, our view is that a rising interest rate environment would not be bad news. Janet Yellen's inflation target of 2%, I think is, that's positive as well. We need some inflation. A deflationary environment is very bad, and her goal for inflation, I think, is positive.
Michael, you want to weigh in?
Well, I think we should first not give out too many awards for people on the Fed recognizing the housing crisis in 2007. Let's pull up page 22 for a second, because this will give you some context for...
Greenspan never saw it, so I think you got to give it credit for that. So.
This is what is driving the markets right now, and I think it's important to understand. This looks at, in real terms, all of the post-war recoveries after recessions. By far, this is the strongest profits recovery and the weakest revenue recovery. Kind of a remarkable coincidence of those two things. Those are the top two charts. And so far, a lot of the profits recovery, or most of it, has come from declines in real terms in interest, credit, and wage costs. So this is a very unique and different kind of recovery. I think it's worth paying more for the profits, but the multiples have already gone up. And I think at this point in the cycle, our view is there's very little to wring out anymore from labor or credit or interest costs. It's going to have to come from top-line revenue growth. I'm reasonably optimistic on what happens to GDP growth over the rest of the year, and maybe we can get some top-line revenue growth, but I think we reached the end of the road of PE multiple expansion. Last year in Europe, multiples went from 7 to 14, which is where they were before the crisis. In the US, the forward PE multiples now are somewhere between 16 and 17, and with the exception of the spike in 97 to 99, that's as good as it gets in a mid-cycle period. So I'm looking for something like 8 to 10% market returns based on earnings growth, and that's about it, because I don't think you get multiple expansion from where we are right now. In terms of fiscal policy,
I have a comment.
The thing that matters to me, if we could just turn to page 32 for a second, because I think this is an interesting chart. Rather than getting into discussions about the level of federal spending, we should talk for a minute about what the government spends money on, because the government does impact issues related to productivity, private sector job growth, small business opportunity, the NFIB small business surveys. And what's happening is all the money that goes to infrastructure, worker retraining, Army Corps of Engineers, high-speed rail, smart grid, compressed natural gas, Environmental Protection Agency, remediation of damaged lands, et cetera, all of that is being gutted. That's on the left. And what's happening is an inexorable increase in entitlement spending on the right. So we're mostly focused on the private sector, but what we're seeing as a backdrop for the public sector impact on private sector growth is a concern over the long run.
Want to weigh in?
Yeah, first of all, I think analytically, I really respect and I read and I agree with most of what Michael said, that I think if you make an investment today, you should not make it on the assumption that multiples will bail you out. But I think you can make it based on the assumption that earnings growth will give you a good reward.
I agree.
But there's one other point I would make, and I don't want to make the bet on that, and when and if it happens, then you've got to take a different orientation eventually to how you look at your investment. The spread, as I said earlier, between what people on a worldwide basis are willing to pay for other kinds of income-producing assets, notably real estate, and what they're paying for the S&P, not necessarily for small caps, but for the S&P, is pretty wide. And if that money flow continues, which I believe it will, that's optionality that you're not paying for right now, which I would not target, but it's something to remember.
Jim, I want to talk about the new issue market for a moment. When we see high yield deals 20 times oversubscribed, does it make you feel like, let me rush and get in them? This is so hot? Or is it the biggest warning sign out there for you sitting in equities? Yeah. When you look at the credit markets, you're evaluating all their asset classes. What's your response?
Well, you know, there's so much capital that's flown into the leveraged loan and high yield market, especially from retail investors that are coming into some of these funds. And so what we're seeing is just indiscriminate.
Doesn't that make you feel 2006 style retail investors rushing into high yield deals?
Absolutely. It's just indiscriminate buying. There are no covenants. There are no covenants whatsoever. It's covenant light. And there's no creditor protections. PIK toggle is back in a big way. So it's hot, right? And so, you know, there was a recent issue, you know, of Clear Channel, which is just an example where, you know, they were refining 400 million of bonds. They had 2 billion of demand and ended up issuing 850. You know, these bonds are very likely to default in the out years. And you're seeing a number of these issues where, you know, there's you know, no understanding of that or credit analysis, really. And so the question is, it's fund flows.
But does anyone care about the out years? Is anyone thinking about things that long term?
Well, I think that's the issue. But when the retail money does come out of these credit funds, or when you start to see default spike, the psychology, I think, will change. But you know, we've seen this movie before, right? We know how it ends, and we don't know kind of where we are. Maybe there's another year to go, but. As we know, when psychology changes, it changes fast, and it's...
Well, there's one person that cared. It was Jeremy Stein, and he left the board of the Fed, right? He was the one that was talking about concerns that maybe some of the credit markets were getting overheated, and I think the dovish wing of the Fed is going to prevail. And I think Yellen will be dragged kicking and screaming to raise interest rates when and if it happens. They've already talked about the fact that they have tolerance for a period of inflation above the Fed's long-term trend. I think that means something like 2.5% to 3% in order to ensure full employment. They've been very transparent about what their goals are, and I agree completely with what's been said about some of the issues related to the credit markets. The question is, when does the cycle end? Right? Most credit markets don't end because they get too expensive. They end because of a spike in defaults and a recession. Now, credit has become less liquid because the street doesn't have the same proprietary trading operations that it used to have. So whatever runway that you used to need in order to get out of illiquid credit investments before the end of the cycle, you need a much longer runway now because the Wall Street is not going to be providing the same disintermediation that they used to.
But that's a great point, which is just that there's no I don't see a catalyst. You know, I don't think any of us. The economy feels fine. You know, you don't feel or see a catalyst, but you don't know where it's going to come from, but it'll come. And I think that a lot of people, you know, looking at a lot of these charts, people are, and I was struck by Justin's chart of, you know, each of those periods ended with a very aggressive, you know, aggressively bad market. And so there's a thought that because some maturities have been pushed out and we don't have to worry about it for a year or two, oh, well, that distress cycle in 2016 will be $1 trillion. You know, I find that everyone thinks they'll be able to get out, and then they don't, and you know, then ultimately they can't, and that's the challenge of the market.
The real question is why they're in now.
Are you talking about the bond market or the stock market?
Credit markets.
Well, both. But, you know, both. I mean, just as an example,
Yep.
as an example, there's this concept right now of TINA. Are you familiar with TINA? So TINA, yeah, you know, great gal, right? So TINA, there's no alternative but stocks, right? So there's no alternative. You know, so a lot of people who think that bond spreads are so tight. And well, the reality is that when you think about a stock, you know, from a technical standpoint, a stock is effectively, you could really, you know, define it as a bond plus a call option. You know, it's a bond on the existing business value, and then a call option on the growth and the upside. And so, if you, to Morris's point about earnings growth, your view of the value of that call option has to dramatically exceed what that bond decline might be. And so a lot of people have been pushed into stocks because they've been pushed out the risk curve. And the thought is that, oh, well, stocks are safer than bonds, so let me flood there, even though there's also so much flooding into bonds. But ultimately, you are exposed. It's multiple, but you are exposed.
The numbers argue against that. People are not being pushed into stocks. If that were the case, why are government bond yields 3.5%? If you knew we were going to have 2.5% or 3% inflation, that means you get no return from the bond yields.
Yeah, because the Fed's buying the entire market.
Well, but that in the Weimar Republic,
they're buying them all.
In the Weimar Republic, the Deutsche Bank was buying the market, and interest rates went through the roof, and they were using money, you know, in baskets. So that's not it. Feds that print too much money destroy the value of money, and they destroy the value of any instrument whose sole value is a function of the value of money, which is any fixed income instrument. So I don't think that's it. I think that what explains it is that people remember 2008. You know, when I was a kid, my parents grew up in the Depression generation, had a different mentality.
So why don't they want covenant on their bank debt now?
Yeah, I'd like to go back to that.
I think if they remember it, why don't they want their covenant?
Well, I'm not trying to argue for or against high yield debt. I'm just looking at government debt where I don't have to worry about getting my money back. What I have to worry about is what the money is going to be worth when I get it back. And right now, I don't get any real interest rates, and I don't get much protection against inflation. And now I think every credit instrument is priced against that. So I don't know about the credit cycle and credit instruments because I think I got at least two great experts here.
If we compare the equity earnings yield today, which you compare earnings on the S&P to the 10-year bond, the equity earning yield is the lowest in 60 years. The equity market is not reflecting accurately the low interest rate environment. So that leads you into the equity markets, I think, in here. I agree with, you know, lack of covenants and all that, but that's very typical. We've seen that in other cycles. When there's a demand out there, the covenants go away. But also, you're forgetting that the high yield duration is much lower. So your duration risk is less as well. But if you look at the earnings yield, it's the lowest in 60 years.
I think you mean highest. You're talking about the earnings yield, right?
Right.
It's the inverse of PEs.
Right.
So if you're looking at earnings yield, it's earnings over price. And on that basis, relative to 10-year treasuries, it looks okay. Pull up chart 19. I think what's healthy about all these discussions is where we are in the cycle. And this is a forward PE on the S&P. Now, we could look at the PE on the median stock and it would look slightly different, et cetera, but let's just look at this for a minute. The reason why we're having these debates is that the PE, the forward PE on the market, is roughly where it crested in 4 or 5 prior cycles, with the exception of the late 90s. So there's a really good debate right now in terms of where we go from here. There wasn't that much of a debate over the last 2-3 years because we were starting from a period of very depressed multiples on depressed earnings. Earnings have gone up, multiples have gone up, and so now there's a pretty rational debate about this. And the real, as we're debating here, what happens next? Do multiples stabilize here and you earn money just based on earnings growth, or is there an additional push to higher multiples because of what's happening to Fed policy? The other reason why there's so much disagreement here, none of us, for all of the years we've been doing this, have ever lived through a period of 5 years of negative real rates. Never happened before, since the inception of the Federal Reserve in the early 1900s. And so you've had 1-year periods, 1.5-year periods, but you never had a 5-year period. By the way, I think it's going to be 7 years by the time it's done, of where essentially there's a 0 to negative real return on cash. So when people talk about the war on savers, it's a pretty long war.
Yeah, I'd like to jump back also a little bit to the makeup of what's going on in the market. I think some of the comments were pick toggles are through the roof and risk is going up. Pick toggles are a little over 2% of new issuance this year, which is dramatically lower than what we saw in the 06 or 07 cycle.
But the fact that the door is open, the fact that they're back, is that a warning sign?
It's a sign that it's a cycle. I don't think anybody believes that there are no more cycles in the financial markets, that we're just permanently going to be going up forever, which means that cycles go up or down. What's happened is the Fed has extended the credit cycle in a significant way, and that extension of the credit cycle is likely to continue. Does that mean we're at the part of the cycle where covenants get a little looser, leverage starts to move up a little bit more? Absolutely. Does that mean that it's time to panic, that it's, run for the doors? Probably not. If you look at slide 13, I think this is important because, and I think you mentioned it, Stephanie, saying, new issuance is through the roof. Is that a signal that we should be worried about? And if you look at this slide, what you'll see is LBO financings, LTM over the last year is less than 3% of all new issuance that's come to market. When you compare that, look at 2007, LBO financings were over 30%. Those are leveraging transactions. Those are things to start to be worried about to make sure that can create that next default cycle. If you look on the next line on that slide, which is refinancings, this year, over 50% of all new issues coming to market is refinancing. That makes companies better, right? It means they're paying lower interest expense and they're pushing out maturities. As was said earlier, what creates the next cycle are defaults. And if we can continue to push off those issues, then that decreases the likelihood that we're at the end of the cycle, as opposed to probably more likely somewhere in the middle of the cycle.
Yeah, I was just going to say, though, I think that reference to LBOs is fighting the last war. I think that this period, I think if you want to pick a historical analogy, the best one to pick is the 1960s, where you had a very similar economic period where you had low and stable inflation, muted economic growth, and in the environment, what was going on is there were go-go funds, momentum stocks. The term, go-go, it all comes from that. And what happened was the low interest rates created a conglomerate boom, and we're actually seeing that now with a lot of these tax inversions. Where effectively you have corporates, who are, because of the speculative deal environment, are able to kind of continue to acquire, and it's a feedback loop. And so if you look at the period of the conglomerate boom in the mid-1960s, as it got later in the economic cycle, 5 years in, the acquisitions started to heat up. I mean, they went vertical. There were just a ton of deals. And we're starting to see that in pharma. There's just lots and lots of deals. But the market started to go sideways, and then with increasing interest rates, it all ultimately collapsed. And with, sort of the turning point was the chemical lease code deal in 1969, where, sort of the end of the boom, and a lot of those names were then down 80% over the next 2 years. So I think the excess this time, it's not in the LBO. The big LBO firms, they can't buy anything. But what you're seeing is it's the Fed induction of sort of aggressive feedback loop activity, which, and again, I don't know if it's another year or two, but it's sort of this manipulation of markets which leads to feedback loop activity, which, ultimately has a spiral down.
Yeah, I'm glad you picked the 60s because Mike hadn't invented the high yield market yet, so that makes it easier. But what I would say is, since the Fed has gotten much more active in policy, so if you look at since 1980, the average economic cycle has lasted about 95 months, and we're in sort of month 58 to 59 right now. So again, that doesn't mean we won't have a cycle, but it does mean that it looks to us like we can continue to have a period of time here, which has, with muted growth, has moderate returns. That doesn't mean we're expecting gangbusters. I think that period of time is over.
Michael, these guys are talking about who's issuing debt. My question or concern as it relates to high yield is who's buying it. We're seeing so many investors flood into the high yield market, and while we're talking about who's issuing deals with pick toggles, you've got retail investors that think pick toggle's an Activision game. That is making some people concerned with who are the current players in the credit markets as the Fed has us searching for yield.
Yeah, that's a good question. The longer the cycle gets, they're starving people of income, and then people make decisions towards the end of the cycle that they wouldn't necessarily make in the beginning of the cycle. I think that for an investor's perspective, you have to remember something. We're debating a lot about high yield here. Most institutional high net worth and retail investors will have a high yield allocation of somewhere between 5 and 8% of a portfolio. The bigger issue is the broader fixed income allocation in a portfolio is not high yield. The Lehman Ag, which I still call it the Lehman Ag, is a reflection of corporates, mortgages, treasuries, and other high-grade investments. Returned negative 1% last year, and will probably return plus 1% this year. So the bigger challenge for investors all across the spectrum of wealth and how much money they control is, what do they do with the money that used to be invested in relatively safe assets? For the better part of 50 years, the quid pro quo was, if you make money, you can invest it in relatively safe assets and earn a positive return in real terms. And that quid pro quo is not in place right now. And our focus is on making sure that we're well aware of where we are in the cycle so we don't get over our skis when the cycle ends. But the bigger question is, what happens to that 30% or 40% or 50% in the case of a defined benefit plan of money that used to be invested in lower risk assets?
Morris, is there such a thing as a relatively safe asset, but one that also returns something?
No. I think that one of the things we learned between 2008 and history is that all assets are risk assets. And right now, in a broad context, I'm not talking about this cycle or whether high yield peaks out or doesn't peak out. Fixed income assets are quite risky because you're not getting paid. There's no growth premium in the price of a risk income asset, but if you go back to the average yield on 10-year bonds for the last 20 years, it's about 200 basis points higher than it is right now. And everybody here agrees the economy's getting better. Not as good as it should be, but it's getting better. And it has the potential, with a couple of policy changes, to do a lot better than that. So all prices are off against that. And I don't think you want to blame the Fed. The only interest rate the Fed controls is the Fed funds rate and the discount rate. Everything else is set by the market. And the market players are more concerned about return of capital in a nominal sense than they are about what the capital that they get back is going to be worth if they get it back.
You don't think Fed purchases of $2 trillion of treasuries and agencies at the long end of the curve is effective?
Only because people are not afraid of inflation. They are more afraid of deflation. That's even though the Fed's balance sheet has quadrupled in the last 6 years. And if anybody had said to you 10 years ago, before the crisis of 2008, that the Fed's balance sheet was going to quadruple and interest rates would stay low, I think you would have bought them a really good dinner. So I don't know I honestly don't know what will happen. I look at the numbers, and I think one of the things that strikes me here, and I'm just trying to be real simple, buy the borrowers if the borrowers are solid. And you got lots of solid borrowers. You got borrowers today that are borrowing money that they have, but it happens to be locked up because we have a messed up tax code. Will that change? I'd like to believe that at some point it will. So those borrowers can literally pay you back with their own cash. Therefore, those borrowers, if they've got good businesses and they're growing, they ought to be able to do something intelligent with their money, including buying back your own stock, but probably some other things. So I think today, if you believe that everything's going to be creditworthy and you believe we're not going to go into a massive recession, which I don't, because I think the financial system is really much safer today, then I think you really look at some of the borrowers, the high-quality borrowers.
John, you want to weigh in?
Yeah, I think it's really a discussion about asset allocation. What do you do with your fixed income portion of your asset allocation, Michael, is what you're talking about, in a rising, potentially rising interest rate environment and a very low interest rates. And, what we're seeing is utilizing more alternative investments as part of that. You can manage the interest rate risk there, and maybe it's a more enhanced fixed income strategy. Convertibles, for example, we're seeing a lot of interest on the fixed income side because if you look at how they performed in prior rising interest rate environments, a very positive performance. So it's really about asset allocation, and really the discussion in here is, hey, fixed income today is not low risk. How do you manage that interest rate risk in this current market environment? So some of the alternatives investments, market neutral, long, short, convertibles, help you manage some of that risk.
Yeah, I would agree with John, certainly in the convertible space, when you think about managing the risk and you think about where we are in the environment. If you believe rates are going to be moving up, but you're worried about some of the equity vol that's started to pick up and James talked about, then I think convertibles sort of has a nice marrying of both that gives you the ability to have some downside protection but still benefit as the equity markets move up. The other area that we're seeing investors look to, and we do find attractive, is still the CLO market. The structured product market for loans still provides returns that seem abnormally high. A lot of that is still due to the 08 crisis. And so you're still seeing where AAA levels, at 150 off, have still not come down to where they probably should be, because there were so many people who have been afraid to come back into that market. And so we think the credit derivative market in the loan space remains attractive and a place to get pretty reasonable return. I would say, Stephanie, the one thing within the bank loan market we are a little concerned about when we see the amount of retail flows that we've seen into bank loans is that everybody really understands what they own. And we believe, a lot of bank loans has been sold on the idea that it's a floating rate product. And today, bank loans, 86% of the market has a LIBOR floor. Generally, that LIBOR floor is around 1%. The chance we get to above 1% LIBOR anytime in the next 12 to 18 months seems very low. And so as rates move up, at least at the beginning, bank loans really won't benefit from that. If you rewind just to 2007, 0% of the bank loan market had LIBOR floors. So it's a totally different market today than it was in 2007. And as the market starts to fully recognize that, we worry a little bit about how retail flows will affect the market over the short term. But if you can be in a little bit more of a locked up vehicle, it should provide a lot of opportunity over the next couple of years.
Jim, let's talk about the IPO market for a minute. Do you feel like the headlines are a bit stale. We talk so much about the flurries of IPOs, how hot the market is. But it actually feels, if you dig down into the numbers, the volumes, they've slowed down a bit.
Yeah, I think that's true. I think, well, the momentum blow up this past month has been, has sort of really slowed that down. And I think that the market, the banks will issue paper until people get stuffed and can't eat it anymore. But with a lot of these sort of really sexy growth companies, what happens is it's just actually a supply and demand thing. You come to market with $100 million of stock and there's 20 billion of demand or some crazy number because there's 1,000 hedge funds who want to be in it to flip it and 1,000 mutual funds who
Real
probably have to hold some
too.
amount. Right.
Don't give hedge funds bad
That's
names.
right.
Real money flips too.
If you can get it, you flip it.
But even people are flipping Puerto Rican bond deals too, which that it's just that is a sign of speculation. But that's a market that's sort of always that concept kind of has always been around. And
is the idea of a sexy growth company, even that term, dangerous? Because what exactly does that mean right now, a sexy growth company? Because for your average investor, it's the type of thing that gets momentum behind it, emotional investing, and people race. What does that mean? Let me show you
what it means. Pull up page 20. I'm not going to use some of your language. I'm going to use different language, all right? So a year ago, this looks at the pricing of companies that are so good, they're going to grow their earnings irrespective of economic conditions, right? And this, over the last couple of years, this has generally been some internet and biotech stocks. That red line shows you that basket. There's a basket of 75 of them. They're called secular growth stocks because their earnings were growing no matter what was going on. A year ago, a little over a year ago, they were trading at 6 times sales. As of 3 or 4 months ago, they were trading almost at 12 times, 11 times sales, and that's only happened once before. So what tends to happen with the kind of companies you're talking about is there's a lot of excitement that's generated, people pile into them, it begets its own rally, and then at some point you just reach a point where there's no more buyers left, there's nobody interested anymore in buying more exposure, and it self-corrects. And it doesn't always take an earnings warning or some kind of negative profit news or economic event to start it. By the time a bunch of stocks are trading at 11 times sales, all that can happen is a few people decide to take profits on their gains and it sets that in motion. And I think we've reached the point in the market where you're going to start seeing these things happening. Overpriced assets. It happened to REITs a couple of years ago. REITs, MLPs, utilities, a lot of the yield-oriented stocks that became very expensive became too expensive to support the valuations.
Yeah. On that note, I think the next area that you may see some of that is, I mentioned small caps, but also some of these buyback stories. It's that expression, what the wise man does in the beginning, the fool does in the end. And it's one thing, back in 2010 or 2011 when a company had a 9% free cash flow yield and they were buying back their stock. Well, today you have a lot of companies where they're buying back their stock at a 3 or 4% free cash flow yield, and if you believe that at some point in the future we have normalized interest rates, theoretically, that can be value destructive versus other activities. So a lot of people have been piled indiscriminately into names that are just buying back their stock, and I think that you could see some real differentiation between companies that are just buying it because everyone else did it, and it's always a contrarian indicator when you see then buybacks are kind of hitting those 07 levels, and that's always a tell.
When you say if you can get your hands on it, you flip it, it fills me with 2006, 2007 anxiety. At this point, does that mean roadshows are for show? Nobody's doing their homework, they're piling into deals and just flipping them? Because that doesn't sound like investing.
Well, it isn't investing, and you may do certain things practically, but they're probably not statistically significant. And I think that roadshows are valuable because it gives you a chance to learn about a business, most of which you'll never buy, and/or you'll buy them many years later. There's one, we're not supposed to name names, but okay, Facebook. We didn't buy the IPO. We thought it was overpriced. We did work on the company, and we thought the company was way behind in the most major trend in technology, which was mobile. So we weren't interested. We watched it. We got to know the company. We had people who went out to the valley to talk to people, and about a year later, we got readings that they were really starting to sell mobile ads, that they had developed good technology, and the stock was considerably lower than the IPO. And I think when the company went public, I heard somebody say that, with all due respect, Mark Zuckerberg had a BlackBerry. I know he doesn't have one now. If he does, he probably looks at it as a museum piece, with all due respect to anybody who has one. So the point being that they learn fast. And when you learn a business and you use the roadshow in that period of time to get a sense of who the people are, what's good about the company and what isn't, you use it later on. So roadshows are really important. And my comment on the flip thing is if something's really hot, unless you happen to be Fidelity or somebody really that big, you're not going to get enough where it really matters to you. On the other hand, even in this environment, there are IPOs that are not well received. And if you can get to know the company, you may have a real opportunity to make an investment early.
Let me jump in on this discussion on the IPOs. I mean, it's interesting, but a far greater impact for the average investor is going to be this whole debate about active versus passive management. And most investors, through 401k plans and a variety of other means, have a lot more money riding on this question than they do on the random IPO calendar. And what's, I think, very interesting and important to focus on is the last 4 or 5 years were generally a tough period for the active equity management business because we were in an environment where the correlation of all stocks went up. All the stocks flew together like a flock of geese. Now that you're starting to see stocks moving more separately, active management returns are adding value. And I don't remember whether it was 2004, 2005, but in one of those mid-cycle years, stocks were up 6%. You earned an extra 3% by being invested in some of the first and second quartile small cap and mid cap funds. So that, I think, is an important thing to keep in mind, which is conditions normalize, we get deeper into the cycle, stocks behave more differently, you can actually add return to the portfolio through active management versus passive management, which is something that we haven't seen in the last 4 years or so.
And John, how do you wrestle with understanding fundamentals, but investing based on the market? Last year, many people looked at the market and saw fundamentally all the flaws with it, but unless you were long, you looked like a fool by December 31st.
Well, I think, you know, it's always a challenge in that sense. And what we saw in the first quarter was risk on, risk off, risk on, risk off during the whole quarter. And when you talk about growth earlier, remember growth is, you're thinking more long term. And then when the market starts to, you know, can't think beyond its nose in here, that's the risk off part of it. So I agree with Michael here. I think we're in an environment where stock selection is going to be much more important going forward. So what we saw in the first quarter was the market, all of a sudden, it's risk on, and then we had the momentum stocks doing well, then almost overnight they changed, and it's risk off. We feel in this market environment, we're in the mid-phase of the market cycle, not the ninth inning. So it's going to be a market, you know, looking at fundamentals, looking at growth opportunities in here. But we're in a volatile period, and you have to try and manage that volatility. But I think stock selection is going to be very important in this last phase of the market cycle.
I think you found something we all agree on, that active management works. Right. But you know, I think that, you know, the one thing is that as we were talking about earlier, we're definitely in the part of the cycle, Stephanie, as you mentioned, that it is true that everybody's rushing into new deals. It is true that many people are not doing the amount of work that they were even 6 months ago. And so when you get to that part of the market, it doesn't mean you're on the precipice of an implosion, but it does mean that you need to start being much more careful about the risks that you take inside of whether it be a credit or equity portfolio. And so the differentiation that you're likely to see between industries, between credits, is likely to only grow as we get deeper into the maturation of the cycle. And I think that's going to be true over both the credit and the equity markets.
I want to give us some takeaways here. Our subject is reading the tea leaves. So from a data perspective, what statistics, what data is most important to you? Because if we sat here with economists, they could read the tea leaves and reread the data however way it suits them. So whether it's What's important to you?
Well, when I'm investing on the, whether it's long or short or equity or credit, the underlying fundamentals of a company and the specific, balance sheet or income statement items are really what matters or what drives me. So that's the data. I think when it comes to economists and, maybe we're mid-cycle, maybe we're late cycle. I think that, very few people can accurately call when a cycle is ending. You can only sort of call what risk reward is. And today, risk reward just doesn't feel that great to me. And I'm concerned that what happened in momentum will kind of extend to other areas, and that's how I think about it. One thing, just for example, that is, I don't see how this could be in any economic models, but, and I'm certainly no expert, but, all of the talk, some of the earlier panels on Russia, Ukraine, whether or not there's war, there's going to be real economic ramifications flowing through Eastern Europe and Europe as sanctions and what other sort of slowdown of economic activity plays out over the next couple quarters. And so how that's going to impact, global economic growth, who knows? But there are things like that we just try to think about those events and how they may impact. But, again, if you spend too much time trying to read the tea leaves, and maybe an hour is good, but if you do beyond that, you can drive yourself crazy.
Well, I think we need to really continually understand that the market is really reflecting the economic cycle. So where are we in the economic cycle? And we seem to be in a slow growth phase. Obviously, the GDP numbers that came out were a bit disappointing. But our view is that the GDP numbers will continue to get better. The global synchronization, as Europe and the rest of the world tries to catch up to us, that's actually good for U.S. companies. So we're in that positive growth phase, hopefully accelerating growth as we go forward. So is that accurately reflected in the equity markets, and how can we take advantage of that? So I think we have to remember that the economic cycle, the market is trying to reflect that. Sometimes it gets ahead of it, sometimes it gets behind it, and obviously it's a much more complicated market where you see all of a sudden, you know what the best performing sector is? Utilities. That's not a growth environment. So that's a challenge we have going forward. So we're a bit more positive because we think the economic cycle is getting better in here.
Yeah.
Michael, what data is most important to you?
So there's two market issues and two policy issues I'm looking at. As I mentioned before, the tightest connection between an economic variable and a market variable you'll ever find is the relationship between these manufacturing business surveys, the PMI surveys, and what corporate profits are doing 3 to 6 months later. If you looked at a chart at it, they are remarkably congruent. So I think a lot is riding on the next 3 to 6 months of business surveys and profits. Corporate profits were up only 3 to 4% year on year in the first quarter. We're going to have to do better than that for the view that a lot of us have, including me, that we're going to end up the year with modestly higher equity markets. So the next couple of quarters of business surveys and corporate profits growth are probably more important than they've been in a while now that multiples have risen. Okay? The two policy issues are number one on energy, the second one on housing. On energy, I think it would be a huge mistake to accelerate the pace of LNG exports. A lot of people like it. I think it's a really bad idea. There's a huge multiplier effect benefit from the United States having electricity prices for households and businesses that are 50 to 60% of the rest of the world. And if you start accelerating LNG export facility approvals, eventually that will feed into higher domestic natural gas prices and electricity prices. So watching that. And then secondly, on the housing front, there's this bill in the Congress that essentially wants to restructure Fannie and Freddie and require the private sector to absorb some bottom tranche of conforming mortgage securitization. If that effectively raises the cost of conforming agency-approved mortgages for households by 0.5% or so, that could slow down the housing recovery. I don't think either of those two things is going to happen, but they're the two biggest policy issues I'm watching.
Yeah, the one other thing I can add to that is Capex spending. There's a lot of capital sitting on the balance sheets of corporations, and if that starts to increase in here, that will also be positive for the market, positive for the economy. So that's another factor to watch in here as a Capex spending.
On that point, though, I think there's one really important thing we're missing that I just think is critical for the audience, which is just that spending and profits are completely disjointed from what the market may do. So we may, in fact, have an increase in Capex, and we may, in fact, have corporate profits go up. That doesn't mean that the market might still not significantly correct from where we are here, just given the fact that all of this that we've had is a pull forward. Right? The Fed is ultimately, the analogy I like to use is that, they're swimming out to shore to a lighthouse they want to get to in the distance, and then the question, though, is, can they swim back? And that we don't know the answer to, and hopefully they can. But everything is a pull forward because eventually, and maybe it's years down the line, but eventually there's a reset moment, and the markets will react to that. And so all of this that we're talking about is still in advance of that reset moment. And so I just think that that's a critical differentiation between sort of performance of corporations and then markets.
And we're still pretty far from that lighthouse, so I'm not going to worry yet about whether they can swim back. I'm sure I'm worried about it someday, but I think the things that, we tend to be long-term oriented, so we spend a lot of time on a business and how it's structured, not just for the next 3 to 6 months, but the next 3 to 5 years. But that doesn't mean that, so we go visit them, things like that, but that doesn't mean we don't look at the numbers today. And everybody's been talking about the sluggishness in the economy. The Chicago PMI was up strong this morning. The ADP employment numbers were up strong this morning. They tend to look out a little bit more. So I think, you look at the price of the security, you look at the price of the class of the securities, and you're trying to see what they discount. And I don't believe they yet discount much growth beyond, let's just say, the current year or next. And I think there's a good chance we'll have good growth and potentially great growth, but I think certain things have to happen for that to happen. So the kinds of things that we will be looking at is, will the tax code be restructured? Will we get mortgage reform, and what the impact of that's going to be? And I think it's premature to draw conclusions on either one of those now, but at least there's a lot of discussion about it, and the incentive for tax reform just went up this week because of the Pfizer-AstraZeneca offer. It's an awful lot of revenues that our government and our economy is going to miss because they just figured out a really interesting way of moving. And you can't stop that in a global world, nor would we. So I think, will we restructure the tax code? I think there's a good chance we will. I think that'll help a lot.
As relates to the data that we look at for the markets, I think there's a couple things. One, by far and away, is fundamentals, which I think is what we started with. But we look at it more from ground up on a company-by-company basis. And I know sort of what was previously said, that the markets and fundamentals can be disjointed. And certainly for a month or a quarter or two, that can be true. But in the credit markets, to the extent that fundamentals are going to continue to improve, the credit markets generally will continue to improve. The reason you get that spread is for default risk. And so if fundamentals are improving, default risk generically is going down, which benefits credit. We look at the length of previous economic cycles and how that's playing into the market and where we are. The type of new issuance that's coming to market, I know we showed that slide earlier. That's something that we monitor very closely to get a sense for how much risk really is coming into the market, the types of risks that are really coming into the credit markets. And the last, which is shockingly how little we spent time on it, but is interest rate expectations and where rates are actually going over the future. Now, we probably spent a lot less time on it because I think 98% of pundits expect rates to go higher, so there's not much to talk about when everybody already expects rates to move higher. And I think that's important to think about because that may mean that a lot of the at least initial move in rates is already priced in when everybody expects it to happen. And we sort of saw that at the beginning of this year where we came in at 3% on rates on the 10-year, and there was probably no one you could find that, or maybe one or two people that thought rates would be lower, and here we sit at 270. Tighter than where we started. So I think the fact that those expectations are baked in, we watch how those expectations change over time, and that's another data point just to think about how the markets may perform going forward.
Does that mean Fed messaging or Fed action is less important from an investing standpoint? It was last spring that Ben Bernanke said, when unemployment reaches 7%, we'll be done with the taper. Well, when that came, the taper hadn't even begun. So does it even affect how you invest anymore?
I think that most investors are skeptical by nature. So even when the Fed tells you they're telling you everything, you don't believe them. And so, yes, they're trying to give us as much information as possible, but the market's going to read into the next data point that they're not telling us. Right. And so it is helpful to have more information, but I don't know that you really believe that you know exactly what they're going to do. And part of that also is, GDP just came out at 0.1%. The economy is not performing as anyone would expect. And so I think that creates uncertainty even at the Fed level. And so even if they gave us full transparency where they are at any minute in time, it's not clear that that actually is what's going to happen unless we really start getting the job growth and really start getting the economy moving forward.
Okay, and I think, the distinction here is that the data today, which reflected first quarter numbers where it was cold outside, and the employment data that came out today, we don't know what Friday's number is going to be like, and I don't believe it pays to get myopic, but the data is not moving in one direction. When the Chicago PMI goes to 63, sharply higher, it shows that there's a conflict in data, and I think when you relate that to the Fed and the way we look at things, I think what they've said all along is they want a stable financial system, they want a framework for growth, and they're not going to do anything to mess that up. So yeah, they looked at the unemployment rate, Stephanie, but they also looked at the labor participation rate. They look at where real growth is. They look at the age of people in the labor force. They look at the employment growth of young people, which is still way behind target. And I think they take all of that into account. And I really think they've been measured, because while they've been doing all that, and while they've been keeping bank borrowing rates low, they've been also making sure the banks don't have any problems.
On a 1 to 10 scale, how bullish are you?
This year, 7 to 8. Longer term, meaning over the next 2 to 3 years, 8 to 9.
1 to 10 scale.
What's my time frame? So 10 years, I'm a 10. I'm ultra bullish 10 years out. Or maybe,
this year.
But this year, 1. I'm pretty bearish.
Yeah, I'm relatively bullish on here, 8 to 10.
So you're 8 to 10 on 1 year. You're 1 on 1 year. You were 7 to 8 on 1 year.
Right.
We remain constructive, so we're probably in the 7. Yep.
We're really doing this?
Yeah.
Okay.
We're doing it.
5 or 6.
We're going to be back here next year, and we're going to check it all.
5 to 6.
Perfect.
5 to 6. And for you, where do you stand on Fed messaging?
John, me?
Michael? John? Oh, we'll go John.
Well, I think, I think there's too much focus on the Fed right now. And it just causes volatility in the market, as was discussed earlier. I think there has to be a little bit more on fiscal policy. Obviously, we have too much regulation. That's not helping growth. We need tax structure revisions in here. So I think it's almost too much focus on. They can only do so much, and they've lowered rates to there and nothing's happening as positive as they would like. I think like I said earlier, I think a normal interest rate environment, actually increase in interest rates would probably be positive for the economy, and I don't think the equity markets reflect that. I think for equity investors in here, you got to look through the near-term volatility and think a little long-term in here. Don't get whipsawed in and out of the market. So look what happened, I think it was 2011, was it? Oh, we're going into a double dip. Everybody bailed out, never got back in. And so last year, go away in May. How did that work out? So you got to look through the near-term volatility, think long-term. Don't let, I don't know if it's high-frequency trading or whatever, don't let the short-term action in the market take you off your long-term plan, in my view.
Michael, we have time for a final thought.
Yeah, over really long periods of time, like 20, 30 years, the real returns on stocks have been in the neighborhood of 5 or 6%. And those real returns are a lot more stable than the real returns on fixed income. So people that are planning for their retirement, regardless of whether retail, high net worth, wherever, owning stocks has been a large component to that, and we expect it to continue to be. I think we need to be also realistic about something else, which is we're talking about the investment side of somebody's portfolio. Chances are tax rates are going to go up, either tax rates or effective tax rates. And for people that make more than $250,000 a year in adjusted gross income, they will eventually be losing more of the deductibility of their state and local taxes, more of the deductibility of their home mortgages and their charitable contributions. And based on the president's budget, there's a 5 to 7% tax on municipal income, which typically had been tax exempt at the federal level. So people are going to have to start adjusting not just their investments, but also their spending if they want to maintain the real purchasing power of their assets.
All right, we have time for one final thought. Who's got one?
Oh, sure. I would just say everyone is a very long-term investor at the tail, towards the end of a very bullish, rising 5-year market. And absolutely, over a long period of time, you want to be long stocks, and that will perform. But people are, typically much more confident at the tail end of these things. Where were the long-term investors in 2009 and 10? So I would just say, if risk reward doesn't feel good, hold cash and wait.
They were buying.
Yeah, I would say important in this market, when you hear everything that we've said, is diversification remains critical across asset classes, and don't get caught up in, there's a lot of excitement over what gets you double-digit returns, whether it be, the next illiquid asset. And it's important to have diversification across your portfolio so that you can benefit. If the market comes down, you have cash to put to work, but if it continues to perform, you're accumulating the right interest income and continue to have good performance throughout your portfolio.
Say one more thing. I think the one thing, and I think everybody's highlighting on it, however you manage risk, make sure you manage risk. And I think there's been a lot of talk about leverage and a lot of things like that. I think one of the lessons that we should have learned from the crisis is that leverage does not pay off. Leverage creates way too much risk. So go for your returns, but don't go for them with leverage. Don't ever be forced to sell anything that you don't want to sell because you want to sell it.
All right, thank you all for coming. Thank you for participating. Morris, Justin, Jim, John, Michael, thank you all so much.